So here's a question for you. Is there a multi-trillion-dollar market, one that's totally hidden from public view, that's about to trigger a crisis that could shake the entire global economy? Well, today we're going to pull back the curtain on this shadow world of finance and figure out if it's all about to come crashing down.
And it all kicks off with this really quiet announcement from BlackRock, the world's largest asset manager. They basically announced they were hitting the brakes, telling investors they could only pull a limited amount of money out of one of their huge $26 billion funds.
Now, a little hiccup like this from a giant like BlackRock, it could be the first tremor before a much, much bigger earthquake. It's a huge potential clue that there's a much larger hidden problem brewing.
So let's really dig into this and break down why this one piece of news is actually so important. Because believe me, this is way more than just a single fund having a bad day.
You can think of it as a threefold problem. First, it's a sign that even the most sophisticated investors out there are starting to get scared. Second, it's a symptom that the underlying market itself is getting sick. And third, it could be a direct cause of real economic damage because a frankly shocking number of everyday businesses are being propped up by funds just like this one.
All right, so what exactly is this system that's at the heart of the whole issue? Let's get to know the main player in our investigation, the private credit market.
To put it simply, if you loan a friend $100 to start a business, that is technically private credit. We're talking about the exact same idea, just on a massive institutional scale. It's all the lending that happens outside the normal, regulated world of banks and corporate bonds.
And the scale of this thing, it's just staggering. Morgan Stanley estimates that by early 2025, this market is going to be worth $3 trillion.
And to really wrap your head around that number, think back to 2008. Remember the subprime mortgage market? The one that caused the whole global financial crisis? That was worth about $1.3 trillion. This private credit market, it's more than double that. Yeah, double.
So the big question is, how on earth did we get here? How did this niche market just explode into a financial behemoth pretty much right under our noses?
Well, it turns out it was fueled by three separate drivers that came together to create the absolute perfect storm for this kind of explosive growth.
First off, the big banks basically checked out. After decades of consolidation and a ton of new rules after the 2008 crisis, they kind of became like McDonald's. They only wanted to sell the simple, standardized stuff, mortgages, credit cards, things they could scale up easily. They weren't interested in making custom loans for individual businesses. And that left this massive hole in the market. So who stepped in? The private lenders. They became the local burger shop, willing to make that custom loan that the big guys just wouldn't touch anymore. The second driver? The insane boom in private equity. Now, these are the firms that buy up companies, usually using a ton of borrowed money, hoping to sell them for a profit a few years down the road. Their entire business model is built on a really simple but really risky formula. Debt piled on top of even more debt. And that created this just ravenous, insatiable appetite for the exact kind of risky loans that, only private credit funds were willing to provide.
So what we have here is this massive, kind of murky and pretty risky system. Now, let's look at the evidence because the cracks are already starting to show.
The first and, honestly, the most straightforward sign of trouble is this. Companies are starting to fail to pay back their loans, and it's happening more and more.
According to the ratings agency Fitch, defaults in the private credit market have just recently hit their highest levels ever recorded. Now, okay, it's a new market, so we don't have decades of data to look at, but the trend line, it's clearly pointing in a very, very wrong direction.
Okay, the second major stress factor is something we've all been feeling in our own wallets: higher interest rates.
Now, you might think, hey, higher rates, good for lenders, right? But actually, for this market, it's a triple threat. First, it makes safer investments, like simple government bonds, look way more attractive, which pulls money away from risky private credit. Second, it pushes all those borrowing companies that much closer to going bankrupt. And third, it even makes it more expensive for the private credit funds themselves to borrow the money they need to make their deals. It's a total squeeze.
And the final piece of this puzzle is the real world, the actual economy, where these indebted companies have to sell things and actually make money, is starting to show some serious signs of trouble.
Take a look at this number. A recent report showed a loss of 92,000 jobs. Now, that's not just a statistic, right? It's a sign that businesses are already cutting back, and it's a cause of future trouble. I mean, fewer jobs means fewer customers, which means less income for these companies, and that creates this terrifying feedback loop of more layoffs and more defaults.
So when you put it all together,
Rising defaults, the pressure from interest rates, a weakening economy. We have to ask the big one. Are we staring down the barrel of another global financial crisis?
Well, let's compare. The market today is way bigger, obviously, but the really crucial difference is the type of asset. 2008 was all about housing mortgages, and the impact was foreclosures. This time, it's about business loans, the money that funds payroll, buys inventory, pays for services. So the impact could be even more direct and devastating: widespread business failures and immediate massive job losses.
And please don't make the mistake of thinking this is all contained in some shadow banking system. No way. Traditional banks are exposed here, possibly to the tune of $300 billion. In fact, the Federal Reserve itself has already flagged this as a potential systemic risk to the entire banking system. So if things really start to go south, can the government just step in with a bailout like they did in 2008? Here's the problem. The world is a very different place now. Government debt is astronomically higher, inflation is already a huge concern, and let's be honest, the political appetite for bailing out a bunch of private lenders is probably zero.
And that leaves us with one final and kind of chilling question. The last time a crisis of this size hit, governments basically printed money and saved the system. But now, faced with all of today's challenges, is that safety net even there anymore?